In this video, I'll show you one of my favorite 1-minute trading strategies, the Momentum Retest Strategy. You'll learn how to identify high probability setups, time your entries using candlestick confirmation, and trade successfully in both trending and range-bound markets. Before we get started, here's what you'll learn in this video: how the Momentum Retest Strategy works and the psychology behind every trade setup, the best candlestick confirmation patterns for precise entries, how to trade the strategy in both trending and range-bound markets, how to use the strategy on all financial markets and during all trading sessions. Before we dive into the strategy, you first need to understand market structure. Without understanding how the market moves, it becomes very difficult to consistently make profitable trading decisions. The market moves in 3 phases, and in each phase, price reacts differently to key levels. An uptrend is a market condition where buyers are in control. It is characterized by a series of higher highs and higher lows, indicating that demand is greater than supply. During an uptrend, the best trading decision is usually to look for buying opportunities rather than selling opportunities. An uptrend consists of 2 important moves. The impulsive move. This is the principal move of the trend. During this phase, buyers aggressively enter the market and drive prices higher, creating strong bullish momentum. The retracement move. After a strong advance, some buyers begin taking profits. As a result, the market temporarily moves lower. During this phase, many retail traders mistakenly believe that the trend has reversed and start shorting the market. However, in most cases, the retracement is simply a temporary pause before buyers step back in and continue pushing prices higher. Our objective as traders is to avoid getting trapped in these temporary pullbacks and instead focus on catching the impulsive moves. A downtrend is a market condition where sellers are in control. It is characterized by a series of lower highs and lower lows, indicating that supply is greater than demand. During a downtrend, the best trading decision is usually to look for selling opportunities rather than buying opportunities. Like an uptrend, a downtrend also consists of 2 important moves. The impulsive move. This is the main move of the trend. During this phase, sellers aggressively enter the market and push prices lower, creating strong bearish momentum. The retracement move. After a significant decline, some sellers begin taking profits, causing the market to temporarily move higher. During this phase, many retail traders believe that the market is reversing and start buying. However, in many cases, this move is simply a temporary retracement before sellers regain control and continue driving the market lower. Our goal is to trade in the direction of the dominant trend and focus on capturing the impulsive moves while avoiding being trapped in retracements. Now, we will focus only on the first 2 market phases, the uptrend and the downtrend. Once we cover them in detail, we will move on to the 3rd phase. During an uptrend, we know that our objective is to buy only during the impulsive moves and avoid being trapped during retracement moves, because this is how an uptrend naturally develops. But how do we know when a new impulsive move is likely to begin? It is simple, by using support and resistance. Look at this chart example. This is the euro versus the US dollar on the 1-minute chart. As you can see, the market first makes a strong impulsive move to the upside, showing that buyers are clearly in control. After this rally, the market doesn't continue moving higher immediately. Instead, it starts pulling back, creating a retracement move. The beginning of this retracement is our resistance level, so let's draw it on the chart. At this point, the market is still below the resistance, so we simply wait and let the price develop. A few candles later, buyers step back into the market and successfully break above the resistance level. This breakout is very important because, according to the principle of role reversal, the old resistance now becomes a new support level. However, instead of buying immediately after the breakout, we remain patient. In most cases, the market comes back to retest the broken level before continuing in the direction of the trend. This retest allows us to enter at a better price while reducing our risk. As you can see, the price retraces back to the new support, and right at this level, a bullish pin bar forms. The long lower wick shows that sellers tried to push the market lower but were quickly rejected by buyers, confirming that the support level is holding. This pin bar becomes our confirmation signal. We place our buy entry at the close of the pin bar candle, set our stop loss just below its low to protect ourselves if the setup fails, and target the next resistance level as our take profit. As you can see, the buyers regain control, the market resumes its bullish momentum, and the price reaches our target. Now let's look at another chart example. This is a downtrending market, which means sellers are in control. As you can see, the market makes a strong, impulsive move to the downside, followed by a small retracement. Here we have a clear support level, so let's draw it on the chart. A few candles later, the market breaks below this support. Once the breakout occurs, the support level becomes a new resistance according to the principle of role reversal. Instead of selling immediately after the breakout, we wait for the market to retrace back to the newly created resistance. This allows us to enter the trade at a better price with a smaller stop loss. As you can see, the market pulls back to the resistance level and gets rejected, forming a bearish pin bar candlestick. This rejection confirms that sellers have regained control of the market. Let's now understand the psychology behind this move. The market first makes a strong impulsive move downward, as aggressive sellers push prices lower. Once the market reaches this level, it begins to retrace because many sellers start taking partial profits, while some buyers attempt to buy the dip. This temporary buying pressure creates a support level. However, buyers are not strong enough to reverse the trend. Eventually, sellers step back into the market and break below the support, creating another impulsive move to the downside. This breakout confirms that bearish momentum is still strong and that additional sellers have entered the market. After the breakout, the market retraces once again. This pullback is mainly caused by short-term sellers locking in profits, while some traders attempt to buy the retracement. As the price returns to the previous support, which has now become resistance, selling pressure increases again. The bearish pin bar that forms at this level shows that buyers tried to push prices higher but were quickly overwhelmed by sellers. This rejection signals the end of the retracement and the beginning of a new impulsive move to the downside. Our entry is placed at the close of the bearish pin bar, the stop loss is placed just above its high, and the profit target is set at the next support level. As you can see, the market resumes its downward momentum and reaches our target exactly as expected. Now that you understand the psychology behind this strategy, you know that we're waiting for an impulsive move, followed by a retracement, so we can catch the next impulsive move in the direction of the trend. However, the entry is the most important part of the strategy. To improve your timing, you need to know which candlestick patterns are likely to form at the end of the retracement and signal the beginning of a new impulsive move. In the next section, I'll show you the most reliable candlestick patterns to look for. Let's start with the first candlestick pattern, the bullish pin bar. A bullish pin bar has three main characteristics: a long lower wick, a small body near the top of the candle, and little or no upper wick. The long lower wick shows that the market tried to move lower but was quickly rejected before the candle closed. Now let's understand the psychology behind this pattern. During the formation of the candle, sellers initially push the market lower, making it look like the down move will continue. However, buyers step in aggressively, absorb all the selling pressure, and push the price back up. By the close of the candle, buyers have taken control, causing the candle to close near its high. In the Momentum Retest Strategy, we don't trade every bullish pin bar. We only want to trade it when it forms at the end of a retracement, right at a key support level. This tells us that buyers have successfully defended the support and are ready to start the next impulsive move higher. Once the bullish pin bar closes, we place our buy entry at the close of the candle, our stop loss just below its low, and our profit target at the next resistance level. Now let's move on to the bearish pin bar. A bearish pin bar has three main characteristics: a long upper wick, a small body near the bottom of the candle, and little or no lower wick. The long upper wick shows that the market attempted to move higher but was strongly rejected before the candle closed. Now, let's understand the psychology behind this pattern. During the formation of the candle, buyers initially push the market higher, making it look like the uptrend will continue. However, sellers step in aggressively, absorb all the buying pressure, and push the price back down. By the close of the candle, sellers have taken control, causing the candle to close near its low. Now let's move on to the bullish engulfing pattern. A bullish engulfing pattern consists of two candles. The first candle is bearish, showing that sellers are still in control. The second candle is bullish and completely engulfs the body of the first candle, showing a strong shift in momentum from sellers to buyers. Now, let's understand the psychology behind this pattern. The first candle reflects continued selling pressure as sellers push the market lower. At the beginning of the second candle, it looks like the downtrend may continue. However, buyers suddenly step in with strong buying pressure. completely overwhelming the sellers and pushing the price above the previous candle's body. This sharp reversal shows that buyers have taken control of the market. In the momentum retest strategy, we don't trade every bullish engulfing pattern. We only want to trade it when it forms at the end of a retracement, right at a key support level. This tells us that buyers have successfully defended the support and are ready to start the next impulsive move higher. Once the bullish engulfing candle closes, we place our buy entry at the close of the candle, our stop loss just below its low, and our profit target at the next resistance level. Now let's move on to the bearish engulfing pattern. A bearish engulfing pattern consists of two candles. The first candle is bullish, showing that buyers are still in control. The second candle is bearish and completely engulfs the body of the first candle, signaling a strong shift in momentum from buyers to sellers. Now let's understand the psychology behind this pattern. The first candle reflects continued buying pressure as buyers push the market higher. At the beginning of the second candle, it appears that the uptrend will continue. However, sellers suddenly step in with strong selling pressure, completely overwhelming the buyers and driving the price below the previous candle's body. This strong reversal shows that sellers have taken control of the market. Now let me show you a real example using one of these candlestick patterns. This is the Australian dollar versus the Canadian dollar on the 1-minute chart. As you can see, the market makes a strong impulsive move to the downside, followed by a retracement, and then another impulsive move. Here, we have a clear support level. Once the market breaks below it, that support becomes a new resistance. Now watch what happens next. The market pulls back to the resistance level, and right at this area, a bearish engulfing pattern forms. This is exactly what we want to see. During the retracement, buyers are trying to push the market higher. However, as soon as the price reaches the resistance level, sellers step in aggressively. The bearish engulfing candle completely overwhelms the previous bullish candle, showing that sellers have regained control. This tells us that the retracement is likely over, and that the next impulsive move to the downside is about to begin. This is our confirmation to enter the trade. We place our sell order at the close of the bearish engulfing candle, set our stop loss just above its high, and target the next support level. As you can see, sellers remain in control. The market resumes its bearish momentum, and the price reaches our target. Now, you might be wondering, what happens when the market isn't trending? That's a great question because markets spend a significant amount of time moving sideways. Let's see how we can adapt the momentum retest strategy to range-bound markets. When the market stops trending, it often enters a range and begins moving sideways between a horizontal support level and a horizontal resistance level. In this situation, we don't trade inside the range. Instead, we wait for a clear breakout. If the price breaks above the resistance level, we wait for it to pull back and retest the broken resistance, which should now act as support. Then, we look for a bullish candlestick signal. Once the confirmation candle closes, we can place our buy entry, with the stop loss below the pattern and the target at the next key level. If the price breaks below the support level, we follow the same process in the opposite direction. We wait for the market to pull back and retest the broken support, which should now act as resistance. Then, we look for a bearish candlestick signal and place our sell entry after the confirmation candle closes. Now let's look at a real example. This is the British pound versus the US dollar on the 1-minute chart. As you can see, the market initially moves higher before entering a range. The first step is to identify the range by drawing the resistance level at the top and the support level at the bottom. At this point, we don't take any trades. We simply wait for the market to show us its next direction. A few candles later, buyers break above the resistance level. Instead of chasing the breakout, we remain patient and wait for the pullback. Eventually, the market retraces back to the broken resistance, which now acts as a new support level. Right at this level, a bullish pin bar forms. This is exactly the confirmation we're looking for. The pin bar tells us that buyers have rejected lower prices, the pullback is likely over, and the next bullish impulse may be about to begin. We place our buy entry at the close of the bullish pin bar, set our stop loss just below its low, and target the next resistance level. As you can see, buyers regain control, the market resumes its bullish momentum, and the price reaches our target. Now let's look at another example. This is the Australian dollar versus the Canadian dollar on the 1-minute chart. As you can see, the market is initially in a downtrend before entering a range. The first step is to draw the resistance level at the top of the range and the support level at the bottom. Now let's see what happens next. The market breaks below the support level, confirming a bearish breakout. Instead of selling immediately, we wait for the pullback. A few candles later, the price retraces back to the broken support, which is now acting as resistance. Right at this level, a bearish pin bar forms. This is our confirmation that sellers have stepped back into the market and that the pullback is likely over. We place our sell entry at the close of the bearish pin bar, set our stop loss just above its high, and target the next support level. As you can see, sellers regain control, the market resumes its downward momentum, and the price reaches our target exactly as expected. That brings us to the end of this video. I hope you now have a clear understanding of how the momentum retest strategy works and how to apply it in different market conditions. If you found this video helpful, don't forget to like, subscribe, and turn on notifications so you don't miss my future trading tutorials. Thanks for watching, and I'll see you in the next video.